Hi all, wish you a good day. I'm DNA and today I'm going to start consolidation, which is usually students find difficult, but actually it is not a difficult topic, right? We'll get to the point straight. Okay, so essential fundamentals for consolidation. These fundamentals are really essential and important if you do consolidation, because without having a proper knowledge on these fundamentals, you can't do consolidation. I'm going to continue after the fundamentals to all the consolidation basic main tasks, right? We'll see the fundamentals first. What is a consolidated financial statement? Consolidated financial statement. Students first misunderstand this consolidated financial statements. It is not normal financial statements. Then we'll see what it is. If there's a company called P, a company, right? It may be your company or someone else's company called P if you have, and there's another company called S, right? As you already know, when you come to the level of like preparing consolidated financial statements in your education, you already know that company P prepares financial statements for company P. Company P's financial statements are there. Statement of profit or loss, statement of financial position, statement of cash flows, notes to the accounts, like that. A lot of financial statements are there for company P. Same set of financial statements are there for company S also. Company P prepares financial statements separately and company S prepares financial statements separately, right? And then, say for an example, P acquires, P is a bigger company, say P company is big. They have a lot of money, they have a lot of assets, everything. Company P acquires or invests in company S. Say S is a small company. P is a big company. P company acquires S. Bigger company acquires a small company by investing in that company. So once P acquires S, this becomes a group. Usually you call it P group. P group. Now P company has financial statements, S company has financial statements. Now you need a new set of financial statements called financial statements of P group. For the entire P group, you need financial statements. So it is known as consolidated financial statements. Financial statements of company P is known as consolidated, not company P, sorry. Financial statements of P group is known as consolidated financial statements. One other thing, when you prepare consolidated financial statements or group financial statements for the entire P and S group, right, you have to use the available financial statements. Available financial statements of P and available financial statements of S. You have to use those two sets of financial statements to prepare consolidated financial statements. So that is consolidated financial statements. Before start preparing consolidated financial statements, there are certain things you have to know, certain fundamentals you have to know, right? We'll see what these are. The value of a company, you have to understand what it is. Parent company, investment, acquisition date, end of reporting period, pre-acquisition reserves, post-acquisition reserves. Knowledge on these things are very important before preparing financial statements. So one by one, we'll see what these things are. The first thing, the value of a company. What is the value of a company? We'll take an example. statement of financial position of X Limited. Say for an example, there's a company called X Limited. For this X Limited, I'm going to take a summarized financial statement or statement of financial position. Summarized statement of financial position. This company has non-current assets of $750. This company has current assets of $250. In total, it is 1,000 assets. Total assets 1,000. Equity, but belongs to owners, equity of 400. Non-current liabilities 500 and current liabilities of 100. So total of again 1,000. So it balances, right? And sometimes one might think that when you buy this company, say for an example, you want to buy this X company, another company, or you want to buy this X company, acquire this X company, right? If someone wants to acquire this X company, sometimes one might think that they will get 1,000 worth assets when you buy this company. So you have to pay 1,000, no value of the company 1,000. Okay, you can't think about it in that way, because when you buy this company, yes, you will receive 1,000 worth assets, 1,000 worth assets. But at the same time, don't forget, when you buy this company, you have to settle $600 worth liabilities as well. Because when you buy this company, assets will be yours as well as liabilities will be yours. Okay, so you can't just think about the asset side only. So you have to settle liabilities as well. So when you buy this company, it is this, that is assets minus liabilities. 400 is the value of this company. 400. You usually call it either net assets or equity. Net assets or equity. Equity, what belongs to owners. So the value of the company is what belongs to owners, or the value of net assets. How to calculate? Assets minus liabilities. 1,000 minus 600, which is 400. Okay, so to find out this, you have two ways. One way is from the total assets, you can deduct total liabilities, or directly in the statement of financial position, you go into the equity and calculate the equity. Equity is share capital plus reserves. As you know, share capital plus reserves is the equity, or you take the value of equity, that is the value of the company, or you can calculate it total assets minus total liabilities. So we learned what is the value of the company, which is equity, right? Then we'll move on to the next area, parent company, right? This is very easy. Parent company. Say there's a company called P and bigger company, say, and there's another company called S, and we acquire or invest in S. P acquires or invests in S. P company purchases or acquires. We don't usually call it purchasing, we call it acquire, right? P company acquires S. So this company P is known as parent. So a company that acquires another company is known as parent. P is known as parent. Okay, so in this case, in this example, P takes over S. So P is the parent. Okay, so one company acquires another company. The company invests in the other company is known as parent. Okay, it's very simple, right? We'll move on to now investment. Now earlier I told you, right, that P company acquires or invests in S, right? So in order to acquire or invest in S, right, you have to pay company S You have to pay company S and buy that company. Okay, you have to pay, you have to invest in. So the amount you have paid or the amount you have invested in S is known as the investment. So it's very simple. Again, I'm telling you the agreed purchase price. In a technical term, you call it purchase consideration. Purchase consideration. So the agreed purchase price that you end up paying to buy S, right? Or the purchase consideration, technical term. In the consolidation, we use this term as purchase consideration, is known as investment. Okay, so P has invested in S, so that amount paid to buy S is the investment. Okay, is the investment. In simple terms, this amount invested by parent to acquire another company. Okay, so that is also easier, right? Acquisition date. Acquisition date. Now P acquires S. On what date? What is the effective date? On what date you have acquired S? Effective date. So the effective date of acquisition. Effective date of acquisition, right? Is known as effective date of acquisition. Is known as acquisition date. We'll see what is the effective date here. Right? We'll take an example. In this example, P acquires S exactly 4 years ago. Not directly giving you, in case you want to find out what is the acquisition date. But in a question, usually this acquisition date is given to you, right? But to explain you the acquisition date, rather giving a particular date, I want you to look at this example, right? P acquired S exactly 4 years ago. Now today is 31st December 2020, for example, right? Today is 31st December 2020. And P is currently preparing financial statements for the year ended 31st December 2020. Okay, financial statements for the year ended 31st December 2020. Correct. P was incorporated. What is the meaning of incorporated? That means you started P, started the company, right? The day you started, the founders started the company was the incorporation date. Incorporation date is 31st March 2012. S was incorporated 30th June 2014. Okay. And what is the acquisition date relevant for the P and S group? Right. So P is there, right? Acquires or invests in S. P was incorporated on 31st March 2012, incorporation date. So this is not the acquisition date, this is the incorporation date. And S was incorporated on 30th June 2014. This is also not the acquisition date. This is the date at which the S was started. Okay. And it says, today is 31st December 2020. We are currently preparing financial statements for the year ended 2020, right? And P acquired S exactly 4 years ago. So this is what we need. P acquired S exactly 4 years ago, right? Now we'll see. 1 year ago means today is 31st December 2020. 1 year ago, 31st December 2019. 2 years ago, 31st December 2018. 3 years ago, 31st December 2017. 4 years ago, 31st December 2016. So what is the acquisition date? If it is exactly 4 years ago, acquisition date should be 31st December 2016. Hope it is clear to you all. Okay, 31st December 2016. So that is the acquisition date, effective date of P acquiring S. Okay, we'll move on to the next. End of reporting period. End of reporting period. This is very simple, end of reporting period. This is the last date of the current reporting period. We learned in the previous example, right? He was preparing financial statements. He was preparing financial statements for some day, right? So current reporting period or the end of reporting period is the reporting period for which you are preparing financial statements. We'll take that example. In the same example, you had a line, right, explaining P is currently preparing financial statements for the year ended 31st December 2020. So you are preparing financial reports or financial statements, or you are reporting to your shareholders or the stakeholders, right, for the year ended 31st December 2020 currently. So current end of reporting period is 31st December 2020. So that is the meaning of end of reporting period. Your reporting period is for the year 2020. So end of reporting period is 31st December 2020. Okay, that's done. Hope you all understood, and it's very easy. Okay, so end of reporting period is 31st December 2020. Okay, clear. Pre-acquisition reserves. This is very, very important, right? So carefully look at it, right? Pre-acquisition reserves. You already know the acquisition date. We'll take that example. This was incorporated on 2014. This is not the acquisition date, incorporation date, right? P acquired S on 31st December 2016. Now, this is the acquisition date, right? This is the incorporation date. This is the acquisition date. Okay. From 30th June 2014, that is the incorporation date, to 31st December 2016, that is the acquisition date, S has generated profits of 12,000. S means the other company. P acquires S, small company. We are talking about the small company, right? Small company. We'll take a timeline, right? This is the best way to explain. In this timeline, we'll mark the incorporation date. Incorporation date was 30th June 2014, right? So 30th June 2014, this is the incorporation date, right? And then P acquires S, that's the acquisition date. So 31st December 2016 is the acquisition date. And it says, right, if you want to find out the reserves, right, main reserve is profit. There are some other reserves also. I'm not going to talk about those things now, because when you come to the level of, say, in your education, to prepare consolidated financial statements, you already know what reserves are. Different reserves are there, evaluation reserves are there, your retained earnings are there, general reserves are there, a lot of reserves are there. For simplicity, I'm taking profit as the reserve, profit, okay, in order to make it simple, right? So from 30th June 2014 to 31st December 2016, that is from the incorporation date to acquisition date, right? This has generated 12,000 profits. So from the date of incorporation, you started the company, so no profits are there, you just started, and then up to the acquisition date, 12,000 profits you have generated, from 0 to 12,000. Now this gap, now you can see acquisition date is here before the acquisition, from the date of date the company started and up to the acquisition date. After the acquisition date only, it becomes part of the P&S group. It becomes a group. You need to prepare group financial statements after the acquisition date. So before the acquisition date, right, they had already generated 12,000. So since you generated it before the acquisition date, you call them pre-acquisition reserves. That means reserves generated before the acquisition date. Before the acquisition date. Okay. So what are pre-acquisition reserves? These are reserves generated by a company before the acquisition date. Pre-acquisition reserves. This is very important. We take this into our calculations later, right? So remember. Okay. So we'll move on to post-acquisition reserves, right? Before that, one more thing. Pre-acquisition reserves. Now, I'll help you to understand this. Now here you can see this is 12,000, right? This is 12,000. At the incorporation date, 0. Now 0 to 12,000. Always pre-acquisition reserves is from the incorporation date to the acquisition date. So incorporation date, it should be always 0. And at the acquisition date, it is 12,000. So this difference, if you take 0 to 12,000, is always 12,000, which is actually the reserves stood at the acquisition date. Reserves stood at the acquisition date. So reserves at the acquisition date is simply the pre-acquisition reserves. Because if you take this gap, it is 0 to 12,000. So 12,000 minus 0 is 12,000. Okay. So pre-acquisition reserves is reserves generated before the acquisition date. That means actually what you have the reserves at the acquisition date is the pre-acquisition reserves, what you have generated from the acquisition date to the from the incorporation date to the acquisition date. Okay. So pre-acquisition reserves are the reserves available at the acquisition date. Reserves available at the acquisition date are the reserves generated from the incorporation date to the acquisition date. Okay. Hope you clearly understood that. Now we'll move on to post-acquisition reserves. Post-acquisition reserves. Okay. Same example is suppose incorporated on this date. Your acquisition date is this. And from 30th June 2014 to acquisition date 12,000 profits, 30th June 2014, and a new line, right? 30th June 2014, that is the incorporation date. From incorporation date to the end of reporting period. This 31st December 2020 is the end of reporting period. S has generated profits of 28,000. We'll clarify this with the timeline. Okay, so this is the incorporation date, right? And this is the acquisition date. We already know this, right? And from incorporation date to acquisition date, reserves generated 0 to 12,000. And this is known as pre-acquisition reserves. You already know this. Now, after this point, this 31st December 2020, as we learned in the previous areas, right? This is the end of reporting period. End of reporting period. So end of reporting period. Now see, we are using them. We are using what we learned now itself. So these terms, these fundamentals will be used everywhere you do the calculations, right? So now, from clearly understand this, I'll help you to understand. Now here see, from this date, incorporation date to the end of reporting period, from the very beginning. Incorporation date, that is 30th June 2014, 30th June 2014 to end of reporting period. Incorporation date to end of reporting period, right? You have generated, right, profits of 28,000, profits of 28,000, right? So here you have profits 28,000. So this is, or these are profits generated from the incorporation date to end of reporting period. Incorporation date to end of reporting period, right? So you can see this gap from 12,000 to 28,000, 12,000 to 28,000, this gap, right, is the profits generated after the acquisition date. After the acquisition date, it is 28,000 minus 12,000, 28,000 minus 12,000, 16,000, 16,000. So this is known as post-acquisition reserves. Post-acquisition reserves. 28,000 are the reserves stood at end of reporting period, and at the acquisition date you have 12,000. So after the acquisition date, reserves generated 16,000. After the acquisition date, reserves generated 16,000. Okay. So before the acquisition date, 12,000. After the acquisition date, 16,000. Total 28,000 reserves generated. Okay. So then what is post-acquisition reserves? Post-acquisition reserves are the reserves generated after the acquisition date up to the end of reporting period. Up to the end of reporting period. Okay. So we'll summarize what we learned, the fundamentals. These fundamentals will be really important, right, for you to do the calculations. I'll come up with the calculations and everything in my next video, one by one. Goodwill, taking the pre-acquisition reserves, post-acquisition reserves, intra-group trading, intra-group profit calculations, all those things, one by one, step by step, right? In my next video, we'll summarize what we learned. Okay, to stop it. Learning points, right? We learned here. The first thing, value of a company. Value of a company we learned. Value of a company is the value of equity. Value of equity is the value of a company. And then equity is also known as net assets. Remember, equity term is very familiar to you, but in consolidation, we mainly use the term net assets rather than equity. Net assets, right? Assets minus liabilities, net assets. Okay, moving on to the next. Equity can be calculated in two methods. I explained you. One method is assets minus liabilities, total assets minus total liabilities. The other method is share capital plus reserves. Equity is what belongs to owners. Share capital plus reserves. Then a company acquires or invests in another company is known as parent company. A company acquires or invests in another company is known as parent company. What is investment? The agreed purchase price or the purchase consideration. P acquires S, so P invests in S. What you invest, what the P invests in S is the investment. And then effective date of the acquisition. Effective date that the parent company acquires the other company is the acquisition date. Effective date is the acquisition date. And then pre-acquisition reserves are the reserves generated before the acquisition date. Actually, this is the reserves stood at the acquisition date, generated before the acquisition date. That is pre-acquisition date reserves. Then post-acquisition reserves are the reserves generated after the acquisition date. I showed it with the calculation, how to calculate pre-acquisition reserves and post-acquisition reserves. Okay. Hope you enjoyed the lesson, right? So see you with the another for the next video of this. Right. So have a good day. See you.